In today's video, we are going to talk about one of the niche categories of mutual fund, that is the Contra Funds. This category of funds is not much talk about category, and here we will discuss about the reasons why it is not a popular category and who should invest in this category. We will also look at the basic details of all the three funds in the category and make a detailed review of the best performing fund in this category. In the later part of the video, we will try to understand the risk reward ratio of this fund, and by the end of the video we shall be able to decide whether to invest in this category or not. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. To start with, let's understand what are Contra Funds. Contra comes from the word contrarian, which essentially means going against the prevailing norms. Contra mutual funds, typically equity in nature, invest in themes and stocks which are non-performers and depreciated currently, but nevertheless have strong fundamental values. So, these funds follow a contrarian view and bet on stocks that are expected to perform in the future. Contra funds are generally cyclical in nature and generate high returns after a relatively long gestation period. So now let's see why to invest. Generally, a relatively higher risk to reward ratio in the long term makes Contra funds extremely attractive and would boast the overall alpha, that is the total returns of the entire portfolio. The second reason is shares in Contra funds are out of flavor or less performing stocks and may not be a part of long-term core portfolio. Hence, these stocks would provide the required diversification to the overall portfolio. Now let's see who should invest. First, the investors with large diversified portfolio and who is genuinely looking for a better diversification than a general large, mid and small cap category diversification. Second one, the investors who has lot of patience and who is ready to wait for a long period, say 5 years and maybe more also, before the fund actually gives a meaningful returns. If you are enjoying my video and find the video useful, do press the like button and also subscribe to my channel if you have not done till now. Your likes and subscription to the video will provide motivation to me. So firstly, let's look at the basic details like AUM, that is total asset under management, which for Invesco India Contra Fund is 8,700 crores, whereas for SBI Contra Fund it is 4,200 crores, and for Kotak India Contra Fund it is only 1,255 crores. The AUM for Invesco and SBI is okay, whereas for Kotak it is on a lower side. Same way, the expense ratio for Invesco is 0.55, whereas for SBI it is 1.33% and for Kotak it is 0.92%. Here, the expense ratio of SBI is a little bit higher. The benchmark index for Invesco and SBI is S&P BSE 500, whereas for Kotak it is Nifty 500. So now let's compare the trailing and rolling returns. On comparing the trailing returns for 3 months, 6 months, 1 year and up to 7 years, it's clear that in longer period, that is 5 years and 7 years, Invesco has performed better. And while in a shorter period, that is 3 years and lesser, SBI Contra Fund has performed better. And it easily beats its benchmark and category with a good margin. On checking the rolling returns for 5 years and 3 years, here the performance of Invesco India is better than that of SBI, and Invesco has been able to beat the benchmark more than 100% during the returns period, which is quite commanding for a fund. But as discussed earlier, Contra funds are cyclic in nature, and it seems that around the start of 2019 it had reached the end of its outperformance cycle and its performance has started deteriorating. Whereas for SBI Contra Fund, last 3 years has been very good and has been outperforming its benchmark and category. So after comparing all the data, it seems that SBI Contra Fund has the potential to outperform Invesco India Contra Fund. And so we'll look at the detailed analysis of SBI Contra Fund now. Now let's look at the sector-wise allocation of SBI Contra Fund. From the table, it is very clear that the fund is equally invested in finance, energy, technology and automobiles. The fund manager is able to pick quite a few good underperforming companies in each category. This balanced allocation provides opportunity to the fund manager to pick companies across different sectors. As evident, GAIL in the energy sector, whereas HCL and Infosys in the technology sector, SBI in the financial sector, and Indian hotels in the services sector are major contrarian bets, and the stock selection seems pretty good and in the line with the fund's theme. On checking the portfolio allocation, it is evident that the stock selection is across all the categories with little more allocation to large caps. The category allocation is similar to a multi-cap fund, and with such diversified allocation, the fund is able to generate a good return and is quite suitable for a long-term investor. Mr. Dinesh Balachandran has been managing the fund since 2018, and after his taking over as a fund manager, the fund has given excellent performance and hope that it continues in future also. Here, this long-standing association of the fund manager with the same scheme is quite positive and an advantage for the scheme. Now let's see how the fund performs on risk parameters. Here, we will compare the parameters with the benchmark index and category average. The first one, mean return, that is the average return in a year, which is 23.28, which is more than both the category average and the benchmark. Here, the higher the value is better. Second, the standard deviation, that is a tool to measure how much the return has deviated away from the mean return, which in this case is 23.48, which is more than both the benchmark and the category average. Here, lower the value is better, but here the value being higher indicates that the fund is having more volatility than the category. This is okay as these funds tend to be more volatile. The third one, that is Sharpe ratio. It's a tool to measure the risk adjusted return, which is 0.84, which is more than both the benchmark index and the category average. Here, higher the value is better. The fourth one, beta, that is the volatility of the scheme compared to the benchmark, which is 1.03, which is same as the category average. Here, the lower the value is better. Alpha, that is a tool that measures how much better the fund has performed compared to the category. Here, it is 5.67, which is far more than the category average. Here, higher the value is better. So here, on almost all risk parameters, SBI Contra Fund has performed better than the benchmark index and category average, which is very positive sign for a fund. Now let's see the upside and downside capture ratios. The upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here, the value is 110, which indicates that the fund outperformed 10% more than the index during the rise period. Here, higher the value is better. Here, the outperformance of the fund is very evident, which is one of the major plus point of Contra Funds. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index has dropped. Here, the value is 94, which indicates the fund declined 94% as compared to the index during the fall period. Here, lower the value is better. Now let's see the risk return graph. Here on x-axis we have standard deviation, whereas on y-axis we have total returns. It is very evident from the graph that SBI Contra Fund has better total returns value with higher standard deviation as compared to the category average and the index, which indicates that the fund has been able to generate good returns with higher volatility than both its category and index. So before coming to the conclusion, what investor should do, let's look at the precautions one should take if you plan to invest in this category. First is, should always review the past performance of the fund so as to understand the fund's performance cycle. Second one, ideally one should not allocate more than 10 to 15% of the total portfolio value to Contra Funds. Third, don't sell the fund in panic in downfall. Instead, should use this opportunity to buy more and average the investment. And the fourth one, as the fund is cyclic in nature, investors should sell the fund at the end of the performance cycle when it has outperformed. So coming to the conclusion, what investors should do. First, for the existing investors, should continue their investment in SBI Contra Fund but keep a close watch on the performance as the fund is in its outperformance cycle and this cycle can come to the end at any time and should sell the investment at the end of the cycle. For new investors, they can start investment as it's a good performing fund, but should also keep an eye on the performance of the fund. I would like to add that I have SBI Contra Fund in my portfolio and am planning to continue its investment in future. Please subscribe to my channel if you have not done till now, and also press the like button. To check my older videos, please click the attached cards to watch the videos. Thank you.